Good morning. What is a reverse 1031 exchange? A CRE investor's guide. So, in commercial real estate investing, timing is everything. If you've ever found the perfect property but haven't yet sold your current one, you may worry about losing the opportunity or facing a big tax bill. And that's where the reverse 1031 exchange comes into play. So, the basics of a 1031 exchange: a traditional 1031 exchange allows investors to sell one property and reinvest the proceeds into another like kind property while deferring capital gains taxes. However, this strategy typically requires that the relinquished property, the one that you're selling, is sold first. So, what makes a reverse 1031 exchange different? So, a reverse 1031 exchange flips the process. Instead of selling first, you're going to acquire the replacement property before selling your existing property. Excuse me. And this option is crucial when the ideal property becomes available unexpectedly and you're not quite ready to move on the sale. So market timing favors the buying before the selling. So investors want to secure an asset in a competitive market is the concept. So with a reverse exchange or an exchange accommodation title holder (EAT) temporarily holds title to the replacement property until your relinquished property sells. So there's some key timelines that you need to be aware of for this. And the IRS rules are very strict. So you have 45 days to identify which property you'll sell. You must complete the entire exchange within 180 days. And failing to meet these deadlines can disqualify the exchange and trigger capital gains taxes. So make sure you play by the rules. What are the benefits of a reverse 1031 exchange? Well, first is tax deferral. You avoid immediate capital gain taxes. It gives you strategic flexibility. Acquire properties when the timing is right. It gives you a competitive advantage where you can lock in high demand assets before others. It's for portfolio growth. Trade into better performing or higher value properties. And here are some important challenges to consider with the exchange process. Financing complexity. Lenders may require more stringent terms since the property is temporarily held by an EAT. Higher costs. Reverse exchanges typically involve higher legal and administrative fees. Strict rules. Missing deadlines can invalidate your tax benefits, so you got to be careful. So the real question is, who should consider a reverse 1031 exchange? Well, reverse exchanges are ideal for developers looking to secure land before selling other parcels, investors eyeing hot market properties who need to move quickly, business owners who want to transition into new space without disruption. It's a big one there. And here's the bottom line. A reverse 1031 exchange gives investors the power to buy first, sell later, and still benefit from tax deferral. While more complex than a traditional 1031, it can be a game changer for those who move strategically in today's competitive CRE market. That's all for today. Have a good day.